All right. So, good evening, everybody.
Good evening.
How many of us here, Dr. Anas Asonye, Chinyere Ifi, and this should be Chinonyere.
Chinonyere is here.
Chinyere, you're welcome. And Jehad Hansen. Jehid Hansen.
Thank you, Dr. Engineer. Thanks.
Who?
No, I said thanks, Dr. Engineer.
This name is a foreign name to me now. Jehid Hansen.
It's actually a female, but
Oh,
yes.
female. Please, can you pronounce it well for me?
It's Jahid Anson. It's my son.
Oh, all right. Jahid, you're welcome.
Actually, it's me. His account is linked to my phone. I'm sorry.
All right. Thank you. You're welcome. All right. Hello? Hello?
Yes.
No, I'm plugging. When I finish, I call you. Oh, sorry. All right. So, everybody is duly welcomed to our evening section. In the morning section was good. Of course, we are entering chapter 6 now, I think so.
Yes.
We finish up everything in chapter 5 this morning. So we're going to try and do chapter 6 with great understanding. However, we still said, please, if we're going anything you do not understand, ask questions. See, there's no, what do we say? There's no, anybody below 20 years here? I don't think so. So if we are not below 20 years, some of us may be around 30, some may be around 30, maybe probably from 35 onward, which means we are adults. And nobody send us to school. We send ourselves to do this. We are not, there's no shame. If you don't understand, there's no need to keep quiet when it's not clear to you. Then the aim of coming to the review class, wasting your time, is defeated if some of the things you do not understand in your way. It's not that you're going to cram it. No, understand it to your own explanation. That will help you. And most of the times, there's no way you can pass life insurance exam without you knowing fully the terms. If not, what we would have done here is just go and answer questions and go. But that, we tried it, it did not help. Some people do that and pass too, but we found out that it cannot help us by just going to any of the talk. You see, like as chapter 6 is now, we just go there and leave this one. We leave the content, we just go and answer the question. Yes, it may work for some people, but generally it's not working for everybody. You have to somehow know what you're answering. What the topics are, what the terms are, before you can be able to answer question correctly. So that will help. So those people who have been coming here, they are passing, the passing rate is okay, but the only thing is that please just contribute to the discussion, make it a discussion class. In that way, you bring out your opinion, everybody bring his or her own opinion. It will be very sweet to be, and in that, if you see that people the rate of understanding will increase, because whatever you speak out is always in you, no matter where you go. You say, oh, this thing, I said it one time. Oh, it was supposed to be like this, or it's supposed to be like that. Now, if it comes to the exam, you get it correct. So, but if all of us come and keep quiet, then it's not, if it's not interactive, I don't think it's good. So let all of us contribute. Let's do it. And we can do it. Nobody here who cannot read this and pass without coming to this review class. That is the funny aspect of it. Most of you are doctors. You see, imagine me, if I'm a lecturer, I'm teaching Dr. Sonia, am I not wasting time by teaching someone like her? It's wasting of time. So, but she come here not because she cannot read it, or some other people too, but because just for that interactiveness, so that she can get what she wants and go, So, however, we are inviting everybody to Dallas come February 5th to 7th. That is Champion Ball. We call it Champion Ball. That's where new millionaires are created. That's where the insights start from. People get inspiration by attending the conference, and people learn a lot. It's groovy to say it. So, just like we said before, everybody who is here, those who are in this class, particularly those who are in this class, if you're coming to Dallas, get your ticket, let us know. We provide the accommodation for the 3 days you're going to stay for the conference. We make sure it's provided for you. But you have to do it on time this week at least, so that the hotel reservation will be done and done on time. So that is a giveaway by Royal Star. All right, let's go to chapter 6, which is life insurance premium proceeds, and beneficiary. There is no way life insurance can happen without a premium. Life insurance can happen without a beneficiary. It's not forced that you should have a beneficiary. Some people who have policies does not have any beneficiary. Of course, if they die, what happened? The death benefit will go to the estate, from the estate to the states. Yes. So it's not compulsory that you must have beneficiary. But we, being our brothers and sisters keeper, being our family's keeper, we want to put a beneficiary. So in case if unfortunately something bad happened, let those who are behind us, more especially our family members, be in control of what the person we left behind. That's the only essence of beneficiary. But to say, is it part of the contract? No. Beneficiaries are not part of the contract. They don't have anything to say on the contract. They do not have any contribution to the contract. The contract is between the insurance company and the applicant or the policy owner. So it's just a contract between two people. So, however, these contracts only come to be by consideration. We said it in the morning. The contract of insurance come to be by consideration. And again, because a life insurance contract is contract of adhesion, which means contract prepared and written by one person. Two people supposed to be in contract, but one person decides that he is going to write the contract. He's going to present anything to you. If you like, you take it. If you don't like, you leave it. So life insurance contract is contract of adhesion. Take it or you leave it. The insurance company never beg you to come and take policy. No. It's there. So whether you like it or not, you take it. In your car insurance, they don't beg you to come. They will advertise to let people know that such a thing exists. They're not pleading with you to come and have contract with them. No. It's left you to go. You need it, you go and get it. And if you go and get it, whatever in the contract is what you take. You don't question what is in the contract. It's already written. The clauses and provisions are there for you. Whether you like it, you take it. The only saving grace is the National Association of Insurance Corporation, not the body that controls it. They make sure that whatever that is in contract that is written by one person, contract of adhesion, that such a thing have a beneficial effect to the insured. That's the only thing why we have the insurance business. So today we're going to look at the premiums, which is that thing that insurance company want from you by managing your risk. Remember, insurance is transfer of risk. You, the insured or the applicant, transfer your risk to the insurance company. The insurance company will say, oh, I'm going to manage your risk, but you have to pay me so-so amount. That so-so amount is what we call the premium. So this chapter 6, we're going to discuss about the premium, how premium are calculated. We're going to discuss about beneficiary, the kind of beneficiary you can put your hand on, the good and the bad. So that's what we're going to see on this chapter. So I know this chapter is not much, but chapter 5 and chapter 6 are always part of the policy that everyone should know, but more especially in the exam, because based on them, what we talk about life insurance is established. Remember, life insurance is made up of provisions and clauses. The provisions and clauses are found in chapter 5. In chapter 6, you now step up forward to look at what is called premium, which is the makeup of the entirety of the contract. And you now begin to talk about the proceeds. What you as a person who applied for policy, what is your proceed? What do you have? What do you benefit by having it? And again, you are transferring a legacy. You are creating estate. Remember, we say life insurance creates estate and annuity liquidates estates. So we want to see the reason how that estate is created. And the only way you can create estate in life insurance is to ensure that what happened, that benefits are transferred to those behind you when the person passes. Of course. And the question again is that, are you transferring it to the right person? Are you just transferring the estate to somebody who is waiting to use the estate to go and smoke? Yeah. We transfer estate to people who does not care, to people who will use it tomorrow to go and buy the best car. And before 6 months, everything crashes. Yes, you have transferred the estate. So not only that we are creating estate by buying this policy, making sure that the family are keeping order, but ensuring that those who are going to benefit from the estate are the right people with a good sound of mind and understanding, more especially to financial businesses. And that's why nobody will do for you. You have to bring your children on board. You're not telling them to do the business, but let them get understanding of this. It's very, very necessary. It's very, very, very important. The children should understand this. Make it as a law, if it's possible in your house, honestly. Make it as a law. In my house is a law that if you're turning 18 years, you must have a life insurance license, whether you like it or, in fact, it's not negotiation. In fact, you don't even negotiate that. You have already known that that's what you do immediately you turn 18 years. You read it, you participate in teaching, you participate in understanding that, so that at least, even if the legacy is going to transfer to them, let them understand how to manage their legacy. That is the only thing. It's very, very important. Let's behave like a Rockefellers. I don't know who have heard the Rockefellers. They are one family. One person just come to make the whole family become rich. One person. Yeah. One person. And he did it nothing but from this what we are doing today. The 500,000, the 250,000 policy can set up a whole generation. Like, it's the truth. If it goes to the right hand and well managed, it can imagine you keep 250,000 for your children to go to school. 250,000 can send at least 5 to 6 people to college and finish. At least 5 to 6 people. Let's not just go big. Let's not exaggerate. That's the truth. So imagine you, even if that person is no longer alive and the people are going to school because of what you have done without any student loan. And don't you think in time the student loan we're talking about will be, if they have not even removed it before then, if they have not stopped it before then, who is sure? So today we're going to look at the insurance premiums, which is the money you pay to get for the policy insurance company to carry your load. Because when you transfer risk to somebody, you're transferring your load to that person. I wish I have all it takes. I would have transferred everything. All the load I have, I transfer it to them. So I let them carry it. I can live a free life. So when you purchase a cup of coffee, look at the analysis. That will make you understand what we're talking about. Look at this. When you purchase a cup of coffee, you immediately receive what you paid for. That is the truth. You paid $3, $4 for a cup of coffee. Where is this coffee shop? What do they call it? The popular coffee shop.
Starbucks.
Starbucks, yeah. Maria is like, you like Starbucks. So, Maria, when you go there and buy a cup of coffee, you immediately see what you are paid for. That's the truth. Because you sip on it, you sip and drink it, of course. So life insurance works differently. You are trading today's dollars for future financial security. Life insurance, you buy something, you are not immediately seeing the benefits. And that is why people do not go to insurance, because they think it's something not worthy, not something useless, because they're not seeing the effect. our mindsets we have put our mindset decision that if we pay for something, we want to see what it is. That's generally how we are wired. But life insurance is differently. You are trading what? Today's dollar for future financial security. So this exchange forms the foundation of one of the most important financial decisions many families will make. This person that wrote this thing is not what? This group that wrote this Excel solution. I don't think they have like insurance company. No? They don't have insurance company. They wrote this in to educate people based on the knowledge they acquired. So we thank Excel Solution for giving us this platform to put more insight to other people to understand. So it's very wonderful. So imagine Sarah. Sarah is just a 5 years old mother of 2 who recently purchased her first life insurance policy. Like many people, she initially found the premium calculation, beneficiary options, and settlement choices overwhelmingly. However, what did she do? He understand these elements helped her make informed decisions that will protect her family financial future. So this chapter explores the mechanics behind what? Life insurance premium. How do we calculate premium? How do the premium come about? How they are calculated, collected, and what factors influence their cost? You know, policy depends on what? On your premium. The amount you can buy depends on your premium. You may have the mind to have $1 million policy, but based on the premium given to you, you say, no, I can't afford this. Can I get $250, $50,000? Or can I get 100,000? So you buy as you can afford. But if the premium is not there, you can buy as many as you like. Even some of us would have gotten more than 100 million now. If there's no premium, some of us would have got more than 100 million policy. But the premium is a checkmate. So as the underwriters are checkmates to who complete it. Why do we underwriters come into be?
Risk assessment.
No. Underwriters.
Oh,
Why
yeah.
did they come to be?
To expel adverse selection.
Correct. Adverse selection.
Which is risk.
So anytime you see the underwriters come into business of insurance because of to check adverse selection. So that's exactly what they are. So probably some in the exam you may see it. Underwriter does not have any business in insurance if not to checkmate adverse selection, because a lot of people have been approved. Even those who are almost a day to die, they prove them, and the next day they die and the insurance company pay claim. So we pay death benefit, and they continue to pay the death benefit. They see that this is no longer funny. They have to establish underwriters who now begin to go through these applications to be able to approve or deny people. That's how underwriters come about. So the premium we're talking about here, we're going to learn everything about premium, how it's being calculated. We learn about the mortality tables that insurers use to assess risk and how your personal characteristics affect what you pay. Your personal life affects what you pay. Your work affects what you pay. Almost you're going out and coming in affect what you pay. And more especially, your health condition affect what you pay. So these are the things we're going to see in this chapter. So whether you are helping a client plan for their family security or preparing for your licensing exam, understanding how premiums and proceeds work is essential knowledge. The concept in this chapter connects directly to real-world insurance situations. So that is something we're going to learn. We want to know how insurance can be of help to our family, how we can use it to plan our financial base, and more especially, what the thing we give back to get that protection, how it's being calculated. So that's the thing we're going to see. So we're going to watch a small video before we go to the chapter terms. The video is just small. So let's watch it and see.
Welcome back. You've made it to the Life Insurance Premiums, Proceeds, and Beneficiaries chapter in your insurance pre-licensing course. Nice job. Stick with me through this chapter, and you'll be one step closer to passing your exam with confidence. Life insurance isn't just about protection. It's about planning. In this chapter, you'll learn how financial decisions today shape security for tomorrow. By the end of this chapter, you'll be able to understand how premiums are calculated and paid, compare different premium funding methods, identify settlement options for death benefits, distinguish between types of beneficiaries, and finally, recognize the tax implications of life insurance proceeds. Let's begin with the basics. Premiums. These are the payments the policy owner makes to keep their coverage active. Let's take a look at how they are calculated. Premiums are influenced by three key factors: mortality, interest, and expenses. Think of it as a triangle. Each side affects the final cost. Mortality tables predict life expectancy. Interest reflects the insurer's investment returns. Expenses include everything from claims to commissions. Now let's look at how premiums are paid. Some people pay once, others monthly. Each method affects the total cost. For example, modified premiums start low and increase later, perfect for someone expecting a higher income in the future. Next, we'll explore how benefits are paid out. These are called settlement options. Whether it's a lump sum or monthly income for life, each option serves a different purpose. Let's break down life income options. These guarantee payments for the rest of the beneficiary's life. Here's a tip. Settlement names often reveal their features. For example, life income with period certain means payments continue for life or a set period, whichever lasts longer. Beneficiary designations are just as important. Who receives the proceeds and how can vary based on the policy owner's choices. Beneficiaries can be individuals, charities, trusts, or even estates. And distribution methods like per capita and per stirrupees determine how benefits are shared. Special provisions like the Uniform Simultaneous Death Act and the Common Disaster Clause ensure benefits go to the right people, even in tragic circumstances. And don't forget the tax implications. While death benefits are generally tax-free, interest earned and certain policy transactions may trigger taxes. This chapter equips you with the knowledge to understand how life insurance works, from payment to payout. Then we have permanent life insurance, like whole life, which stays in force for the insured's entire life, as long as premiums are paid. These policies build cash value and offer long-term financial benefits. Ready to dive deeper? Let's explore each section and prepare you to pass with confidence.
All right. So these are the keywords. In every chapter, we have tried to go through the keywords. The keywords are those things we're going to see as we proceed to the content, the chapter contents. So these are the valuable keywords, and which I will encourage everybody to understand and understand it at least to your own definition, to your own interpretation. It may not necessarily the way they write it, but understand what it is by your own word. So that even if you see it in the exam, you will understand. So let's look at grace period. We have come across grace period even in chapter 5. We come across grace period. Grace period even applies in everything we are doing. If you are paying any bill, there is a grace period. Any bill, your mortgage, there's always a grace period. Your electric bill, there's a grace period. Your telephone bill, there's a grace period. That period that your bill is due, and they say after this period, they do that, they give you 2 days before the penalty is charged. That's a grace period. So for purpose of this life insurance review and this life insurance, the time after the premium due date during which payment can be made without penalty. The grace period in life insurance is always 31 days or 30 days. Some people will say 1 month. But however, the best thing to do to get it clearly is as we meet grace period, you write it in a piece of paper or any note or jotter, any note you are using, you write grace period, write what it means. Now, you go back to your state part of the exam, part of the reading, you find out what your state says about grace period. Whether they said it's 30 days or 31 days, or whether they use 1 month. Some states use 1 month, some states say 31 days. So just check the grace period of your state. It's very, very important. You want to know that. The grace period is applied in life insurance, is equally applied in health insurance. The grace period. So please try and know what it is. By just knowing what it means here, will not help you. What will help you is that you, in your own state, you know the grace period of your state. Because you may see it on the grace state section of the exam, which is 35 questions. Those state sections, the 35 questions are always easy. If you have revised it, they don't have much scenario questions attached to them. It's a straightforward answer. So grace period. Then we have policy lapses. The time policy terminates due to no payment of premium. Now, put in perspective what we learn about term life insurance and what we learn about whole life or permanent insurance. The term life insurance, when the policy lapses, what happens? Your policy terminates and there it ends. You may not receive anything. You may or may not receive anything. You will only receive if you have return of premium rider attached to your policy in term life insurance. If not, you are not getting nothing.
Nothing at
If
all.
your policy terminates, there it ends, except you have return of premium attached to your term life insurance. And that return of premium will always be in place during the time the policy was initiated. So if you don't have it, you cannot get anything from the policy. When your policy lapses due to non-payment. But in permanent or whole life insurance, it's not always like that. We have automatic premium clause or provision that come in to help. If your policy lapses, the automatic premium provision will set in immediately in permanent or whole life insurance.
Permanent or whole life.
Yeah, because they have cash value attached to them. So
That's
if your
right.
policy lapses, then this one will just come in immediately to begin to pay your premium. And if you have, they will only that automatic premium provision will come in only if your policy have had cash value in it. If you buy a policy today and you are paying monthly, it's gonna take time before you can just start generating cash value. So the person who brought your policy may say, "Oh, pay annually." He or she is doing good thing to you. He's trying to prevent that policy from lapsing. And the best thing you can do to yourself is pay annually. 1, you are preventing the policy from lapsing. 2, you are quickly generating cash value, which can work in your favor. Nobody knows tomorrow. If you're paying policy monthly, there's likelihood, almost 90% likelihood that you may one of the month you may not be able to meet up. But if you pay annually, you have paid it for 1 year. You'll be resting until the next year. That's the truth. So annual payment is always right to help you avoid policy lapsing. Loading charge is an excellent factor in premium calculation. We're going to see it. Loading charge. Remember, premium is calculation is like triangle, which we will see. We're going to discuss the triangle part used in calculating premium. So loading charges are what's seen in premium calculation. We're going to see loading charges. Loading charge. Mortality table. Also, we're going to see mortality table in when we are doing calculating premium. However, the mortality table will show what? The probability of death at each age. Probability of death at each age. In every community, there's always a mortality table. In that mortality table for every community, will show you the incidences of death, what causes death, the age of death in the community. So based on that, you'll be able to know whether these people will die of so thing. Because if in every community what's killing them is madness, you already know that the next 2 or 3 people who come to your clinic will be mad to die. So that's what it is. Now, surrender charges, surrender value. You talk of surrender charges in permanent or whole life insurance. Do not talk about surrender charges in term life insurance. It does not exist. We only talk about surrender value or surrender charges. In surrender charges,
What?
the money they charge you. But the surrender value is, you only talk about it when you have what?
Cash value.
If you don't have cash value, you cannot talk about surrender charge. I mean, even surrender charge. Because in the surrender charge, when you surrender your policy or when your policy lapses, if the policy have a cash value, they're going to take out this surrender charges, which comprises the administrative fees and other fees attached to you surrendering your policy. Then the remaining the one be given to you as surrender value, which is the cash value returned to you, the part of the premium they decide to return to you. So that is surrender value. Now we have policy loan. In your policy, more especially in permanent or whole life insurance, you have a policy loan that you can access. You can only access a policy that have a cash value. You cannot access loan on term life insurance because it doesn't have a cash value. I remember that policy loan, why you can access it because the cash value in that you are using as a collateral to get that loan. Such as if you're from Africa, before you go to bank to collect loan. In fact, my country, I'm from Nigeria. Before you go to bank to collect loan, before you collect a bank, they ask you to bring the grandmother. Where is she? No, I tell you the truth. You gotta bring everything. You are collecting 50,000, but the collateral you bring may be more up to 500,000.
Oh my God.
Yes. It's just like in my country, there's nothing they do. Bailing somebody from, if somebody commit an offense, you are going to bail that person. Shorty, they call it shorty. If you go to shorty somebody, maybe who the courts or the law has committed crime, or the person who is under trial, the shorty, they will tell you, oh my God, sometimes they will tell you to bring first class in government, first class in federal parastatals. And those federal parastatals, they are first class there or what? You may not see 2 people who is there. So giving you a condition that you cannot be able to
fulfill.
You cannot fulfill it. Who are you to fulfill it? So at least they justify that they have given you bail, but you couldn't fulfill your bail. So that is it. So collateral, the cash value is a collateral to the loan you are collecting from your policy. So why would somebody leave a policy you go and buy so that tomorrow, if there's any cash need, you can go there and get a loan and go and get a policy that will know that such a thing does not exist? Does it make sense? They will tell you term life insurance is cheap, just to lure you into it.
Yeah.
What do you mean? Is the costless? It's only cheap within that period that you are the first term, which is if you use 20 terms or 30 terms, that first 20 years or 30 years is cheap, yes. $2, $3. Of course, there's no cash, there's no living benefit on it. Now, when you will need policy is when the policy will term, and that's when you're gonna renew it. And by that time, you are of old age. Probably by that time, you're no longer working. Or probably you're working, but you're not working as you used to work before. Then paying the new premium becomes so difficult to you. So policy loan only come from a policy type that have cash value in it. And the cash value, they give you the loan because they use the cash value as a collateral. Settlement option is the proceed of the policy. How is it being distributed? You are the policy owner. Of course, you're going to talk about the settlement option. The beneficiary, how are they going to be settled? Do you want them to go and get lump sum? Do you want them to get family income where every month they pay them social amount? Or you want it annually to pay them annually? Or do you want it to be in the insurance company, white insurance company, pay them interest every year? Or do you want it to be on your trust, so that indeed the trust can control it? So there's a lot of ways of settlement option. We're going to see the settlement options. Contingent beneficiary. Of course, who are the beneficiary? That settlement, who are they? Who are they? Are they the right person? Do they have the knowledge to manage whatever you're going to leave behind? That's the contingent beneficiary are the second person in the beneficiary line who comes if the insured and the primary dies, is no longer available. The contingent we call. Then there is tertiary beneficiary. That person who comes when the primary, the contingent, and the secondary, the contingent are not there. So we have what we call the spendthrift. The spendthrift is a provision that will prevent creditors from claiming any portion of the policy proceed. You know, if not spendthrift clause, in fact, you see people who design this, they know what they're doing. I'll tell you the truth. If not this spendthrift clause, you know what happened? Immediately somebody passes and he has a policy. Those who the person is owing will line up to get their money. Or if somebody passes, maybe the person must have passed in hospital. They carry the person from one place to another. The people that carry the person to the morgue, the people bring them to the morgue to burial. The last doctor that treats him, the nurses, all those people, they have to be paid. So if not spendthrift clause, those people, for the fact they know that this person, this man or this woman has a policy, immediately the person passes, they will come and line up and you must pay them. So the spendthrift clause provision prevent creditors, such as those one in the hospitals, such as your people who are, or the government you are owing student loan, such as anybody you are owing, coming to claim that proceeds from the policy. So that's what spendthrift clause does. It prevents creditors from claiming any portion of the proceeds of the policy proceed. That's policy, the benefit, the death benefit. So common disaster clause. This is another provision that specifies how proceeds are distributed if the insured and the primary beneficiary die in the same accident. If two people, they remember, somebody has policy and they have beneficiary. The first on the top of the beneficiary is the primary beneficiary. So if somebody have policy and died, the primary beneficiary is still alive. The primary beneficiary will go and collect the money. Nothing will come to the secondary beneficiary. Nothing will come to the tertiary beneficiary. They are just second and third in line waiting. So except the primary beneficiary is not alive, the insurance company will not contact the secondary beneficiary. So if you met anybody secondary beneficiary, you're just keeping that person in line. That person does not participate to get the proceeds from the policy. So the common disaster clause is going to tell us what if this primary beneficiary and the insured died in the motor accident or died at the same time or died in a plane crash at the same time. What happened for the secondary beneficiary to collect the proceeds? The only thing that can happen for the secondary beneficiary to collect the proceeds is what? Even if these two people die at the same time, the insured and the primary beneficiary die at the same time, due to common disaster clause, it will be assumed that the primary beneficiary died before the insured. Please know that. Due to common disaster clause, if the insured and the primary beneficiary die in the same accident, of course, when they die, something like an accident like that, or in a plane crash, you wouldn't be able to know who died first. Two of them died. We wouldn't be able to know. But due to common disaster clause, it will not be assumed or it will not meant to believe that the person who died first within the two people are the primary beneficiary. He dies first before the insured. The reason why they do like that is this. So the insured have transferred the beneficiary rights to the secondary. If there is no common disaster clause, if the insured and primary beneficiary dies, the secondary cannot collect the benefits. So because of common disaster clause, the secondary or contingent, you can see it as secondary or contingent. The secondary or contingent will not collect the beneficiary. That's due to common disaster clause. The tertiary beneficiary does not come into play at all, except the secondary and the primary is no longer there. So, all right. So we have been able to talk about the terms. Let's go to the insurance premiums. The premium is what you buy, what you pay to get the policy. Is what you pay to the exchange of your risk. You get the risk, you hand the risk over to the insurance company, and the insurance company now say, please, I'm going to collect this your risk, but you have to pay me so amount for me to keep the risk. That so amount is the premium. So in this chapter, we're going to look at how premiums are calculated. What are the premiums? So let's look at factors in premium calculation. You look at this table: mortality, expense, and interest. In here is what you see called the premium. Where it contains all of them. Mortality, interest, and expense is talking about premium. So life insurance premium are calculated per 1,000 of coverage. 3 primary factors are used to determine what an insurer is you. We charge. Insurer is the insurance company. We charge for its life insurance products. That is what they use, these factors, the mortality, the expense, the interest, to find out what they will charge you for the insurance, for every insurance product. And the good thing about it is that insurance is calculated per 1,000 of coverage. So that's how insurance is being calculated, per 1,000 of coverage. That's how they calculate insurance. So, and the insurance premium calculating, they calculate premium based on 1,000 per coverage. Now, premium calculation is based on the mortality, the interest, and the expenses. These are the things that we're going to use to find out how premium are calculated. However, premium calculated based on 1,000 of coverage. So let's look at the 3 factors that influence the gross premium charge for life insurance. That is the 3 factors that contribute or participate in the premium we are paying. If we are paying so high, these 3 factors one of them must be so high. So that's what we're going to see in the first one. We're going to see the premium calculation, the role of mortality factor. Then we're going to look at the mortality factor. Remember, initially we said there's a mortality table. What the table is showing is in a particular set of people, the mortality table will show if people are dying, what caused the death, at what age those people die, what are the risk factors around there. That's a mortality table, the factors that help us to calculate premium. Now, the mortality factors has the greatest impact on premium calculation and rate making, as it can vary substantially based on what the insured characteristics. The mortality factor is determined from a mortality table, which indicates the probability of death of an individual at any particular age. So let's assume, if you look at it, like I live in Rolette, Texas. If you look at Rolette, Texas as a city, now the rate of people dying in Rolette, of course, the mortality table has shown us the rate of people that dies in Rowlett, Texas, what contribute to the death, and at what exact year do they die. So if you get all those factors in hand, that will help the insurance company to make a good decision based on the premium they're going to charge. And because of what happened around that community, the tendency of that person, that thing happened around the community, happening to that person is there. So based on that, they're going to calculate your premium. So let's look, it said the mortality table provides the death rates. So look at what is in the mortality table. It provides what? The death rate, which is the average number of deaths per year in each age group. For mortality table to be accurate, it must be based on large cross-section of individuals over a long period. Just like I use Rowlett City as an example. If they go back to get the mortality table of this city, that will show us the number of people that dies. Why do they die? At what age? So if we know those, that will help us in making decision on the right rate in our premium. So this mortality factor originates from the Commission Standard Ordinary, COS mortality table. So just know that mortality table contribute to premium calculation. Let's leave all those down. Now, understanding the interest stroke investment factor in insurance premium, the interest stroke investment factor. Insurance companies would invest the premium they received on to earn interest. Did you hear that? Insurance, they pay the premium. Remember, when you pay this premium, we have in the morning said that these premiums are channeled to different areas. One, you pay the premium today for your policy. One part of the premium will go for expenses in the office, or office expenses. Part of the premium will go for claim payments. Part of the premium will go for commissions. Part of the premium will go to cash values. So these are the way premiums are distributed. So when we're talking about premium getting interest, we are talking of that part of the premium that goes to cash value. That will tell you that the part of the premium that goes to cash value is not all the premium you paid. It's just a section of it. A little section of it is transferred to cash value. And you can see the rate of increase of that little portion that was transferred to cash value. Imagine if all the money is sent to the cash value, the interest build-up that you have. But that little as going to cash value is giving that impact. So you pay your premium to that insurance company. The insurance company go and invest your premium to earn interest. Just like you pay you pay your money to bank. Immediately you pay your money to bank, you turn backwards. Bank will carry that money to go and invest on anything they want. That's what they do. So today, the teaching is telling us that we want to do that in the bank's doors. And what is that in the bank does? We want to use our money to create interest. That's just the thing. You put your money in the bank will turn around to take that money to make some money. And at the end of the year, they give you 0.001%. At least most of us today have received our tax paper this year from the bank. So, but you put a huge sum of money there, you know. You log in every day, you see written note that yes, the money is there. Like I keep on saying, the one lady told me she has more than close to $200,000 in her account. So I said, please, the best thing for you to do now, there's no much, you are not married, you are single, just go and write at least $1 to $2 million policy for yourself. Then get some money out there, go and use 40 or 50,000, go and write annuity that will guarantee you income for life. If you do those two things, I was telling the lady, If you do those things, you have already set up your life for life. Then the little one that happened, use it. You can call it keep it in the bank. You can be seeing it. So the lady turned around to tell me, so, oh, Mr. Bat, I want my money to be where I'll be seeing it. I laugh. I say, yeah, you want to put your money where you will see it. That's correct. But this thing I'm telling you today is something you pay money to go and listen to get knowledge you pay money to go and get from somebody. And believe me, that lady is not up to maybe around 25 or what, 26 years. So imagine this girl that has close to 200,000, which she opened her account, I saw, close to 200,000. Imagine this girl. We go and write $2 million policy. She can afford it. She can pay annually. She can afford it. And she keep on paying them $2 million policy. And go to that money that is there sitting in the bank. Take at least 40,000 or 50,000. Go do annuity. Do annuity with long-term care as a rider. She is made for life. She has prepared her retirement already. I'm telling you the truth. I talked to her. She said, no, she wants her money to be where she be, logging every morning to see it. Not knowing that, look, I think what I have to do, I have to call that lady again, see what's going on. I think I have to do that. So see whether I can convert her to understanding what we are understanding now. Yeah, I will do that. I'll try again. So you put your money in the bank, you turn around, that money is invested by the bank. All the banks, including where you buy your coffee, all of them have a life insurance policy. All the banks have policy. You ask yourself, if all these banks have policy, and if life insurance policy is for death, you ask yourself, when will all these banks die? When this one's I said, Starbucks, when is it gonna die? If life insurance policy is for death, because all of them have policies. There is a book that will be given to you to read when you pass the exam. Matthew Life and Health weighty physician and such. You'll be given anybody that passed. I think that's the first book that will be given to that person to read. Money Worth Life Insurance. Money Worth Life Insurance. That's the name of the book. Money Worth Life Insurance. Money Worth Life Insurance. You can copy it and Google it and buy and read. Money Worth Life Insurance. That's where you see all the banks, how much they have in the life insurance. All the banks, all the big organizations. So they confuse all that life insurance is when you die. Then if those banks are getting life insurance, when are they going to die? So we're going to see the interest and investment. Insurance companies invest the premium they receive from you to any interest. You ask again, where are they investing it? Everybody's coming to life insurance to invest. Then where is the life insurance investing their money? I think somebody's supposed to ask that question. If everybody's coming to invest their money in life insurance company, when an insurance company is investing those premium, where are they investing it? One of the way they invest is in the stocks mutual companies. See, money is in the circle. So we want to enter as we go through the circle, we want to enter the portfolio that we will not be thinking that we lose our money to go through the circle. That is exactly what it is. So this interest is one way an insurance company can lower its premium rates. Premium calculations are based on the assumption that the company will earn an assumed rate of interest. A higher assumed or predicted rate will result in lower premium. However, the actual interest earned may be higher or lower than the assumed rate. So the interest factor reflects an insurer's return on its investment. The insurer invests the premium. It collects in multiple investment vehicles. the wiser is investment decision, the better return it will realize. Remember, what's that name of the company, type of insurance company that if you have policies on them, you become part owner of the company? You follow them to share their profits in form of dividends. What's the name?
Mutual. Mutual.
Mutual, yeah, mutual. Yeah, if you have a policy mutual company, you're the part owner of the policy. I mean, part owner of the company, because you follow them to share benefit and you follow them to share the loss. And more especially, because you have a policy with them, they give you the freedom to participate in electing their boards of directors. If you can elect a board of directors, you can equally be elected to be board member. So that is what it is. So it reflected to the interest. What we just learned about the interest. When these people have a higher interest, what do they do to their policyholders? They will reduce the premium. They will reduce the premium. And remember, when they reduce when they lost, if they don't earn, they lost, the company is losing. What they're going to do? They're going to increase the premium. Yes. You follow to share the good, you have to follow to share the bad. If there's anything seriously is happening, they will increase their premium. So that's how it is. All right, so we're gonna go front to expense factor. What are the expense factor? We just telling you, we do know what expense factors on life insurance is. Those factors put together will now get you what your premium will be. The expense factor, also refers as the loading charge or factor, is derived from operating expenses. These are the expense factor. The operating what? Expenses. So they are the expense factor. So the higher the operating expenses, what will happen to the premium? The higher the premium. The lower the expense factor, what will happen to the premium? The lower the premium. So the expenses include death benefit paid, commissions, salary to the producers, other employees, as well as other administrative costs, e.g. rent, are all expense factor. So these are the factors that can contribute to what we call premium. How your premium be charged to you, how much, how it's be calculated is based on these factors. The factors which include mortality table, interest, and expense factor. So these are the three things that can determine. In three of these, you can see that the greatest of all of them that will get more percentage is the mortality rate, because that's where your health condition is. Yes, they contribute more to the premium. We're going to see it. So additional factors that may influence the premium cost include what? Age of the proposed insured. Your age determines what? How much premium you pay. You can't compare a 60-year-old man with a 15-year-old boy. It's not going to be the same. Their age, the 60-year-old man is almost close to going to meet his maker. A 15-year-old is still young, has still a long way to go. So the 15-year-old will have a lower premium compared to 60-year-old. Sex or gender is another factor that determines your premium. We agreed, we know that sex plays a greater part in premium calculation. We know that in gender, if you're male, your premium will be higher. If you're female, your premium will be lower. So males pay more higher premium than females. That's what we have to know too. So health history of proposed insured. Your health is a factor that determines your premium. The occupation, the higher the risk in your occupation, the higher the premium. Personal activities and hobbies. What is your lifestyle? Your personal activities, what do you do? Those things, what are used in calculating your premium. Your personal habits, do you smoke? Do you drink? Those are the factors that can affect your premium. So you can see that premium is not just one thing. They put all those factors together to say this is what your premium will be. So let's look at the net single premium. Net single premium. You bought a policy, you just decide to pay the whole thing at the same time. But what happened to the fear of MEC? If you ever fund your policy, what happened? You resort to MEC. And when you resort to MEC, it's not a good thing, though. So the net single premium is a premium that makes provision for mortality costs. And what are the mortality costs? The death benefit and interest. The net single premium is influenced by the assumed interest rate, the proposed insured gender, the benefit to be provided, and the mortality rate, that is the death benefit. So look at the premium, how we calculate the premium. You can write it down in case you see it in the exam, how premium are being calculated. Premium is what? Mortality cost minus interest. So you can just write it down. Net premium is what? Mortality cost minus interest. So mortality cost is a big factor there. So copy it down. Sorry, just give me a second. Let me do it first. Sorry. It's like
What
Texas is gonna be connectivity or what? It's cold outside. Cold. Seriously cold. My God. All right. So at least everybody have known how to calculate.
Seriously, code. Engineer Bat, we're expecting like up to say, is it 10 or 20 this side?
I don't know what it's gonna be. So it's gonna be cold. They say tomorrow it's gonna snow, a lot of things. It's already cold now. In fact, you go outside, you can't even you run inside.
Snow on Maryland
Seven.
from Saturday night throughout Sunday. It will
Wow.
snow all Sundays. All Sundays.
Wow.
You have a single digit or below freezing.
Wow.
Below freezing by
I said for it to reach Texas by if you go outside now, it's like, oh my God. All right, so let's look at single premium. Write it in your paper how to calculate the premium. Single premium is mortality cost minus interest. You can see the mortality cost is always a big deal in calculating your premium because the mortality is where your head is based on. What will cause the death? Definitely, most time the cost of the death depends on the risk level. So all those are embedded in mortality. So the net level annual premium is the premium calculated to cover the present value of future benefits. The net level annual premium is the premium calculated to cover the present value of future benefits. Remember what we say, premium is what we pay to cover the present value for future benefits. Life insurance is what? We use life insurance, we pay life insurance to what? For today to prevent future loss. Or more especially, if you buy life insurance to benefit ourselves, we suffer today agony for a benefit tomorrow. Financial benefit, family benefit tomorrow. So that is it. So most people buy life insurance, they have to eliminate some things they do. There's no more Amazon dropping a lot of things in your front. You curtail it. Yes. Sometimes Sometimes I go to my wife's wardrobe. I say, honey, most of this cloth, if we have used it to buy life insurance, it would have been better for us. Yeah, it would have been better for us. But thank God, since she was delivered, she's no longer doing Ashebi and all those things. Because she now used that money to pay her policy. So deliver yourself. Nobody will deliver you. Prayer, won't solve this. No. It's God has given us the ability. It's you. It's no longer to say prayer. The ability has been given to us by God. So no more praying about it. You have the ability. It's only to discipline yourself and do it rightly.
That's right. That's right.
If you begin to pray from today to Monday,
And if you don't apply yourself, it will
telling you.
never happen.
Yes. So the net level premium, this is the way we have seen how we calculate it, the mortality cost minus interest. So that will give us. Now, let's look at this example. It says, suppose an insurance policy promised to pay 300,000 in 25 years. In that case, the net level premium is the amount acquired annually to ensure the 300,000 available to the end of 25 years. The calculation assumes the premium will not be paid in a lump sum, but over a period of years. Of course, the gross premium is premium charged by an insurer, comprised of or influenced by the factors described previously, which are mortality, interest, and expenses. These are the factors that affect gross premium. This represents the actual premium paid by the policy owner for life insurance coverage. So what is the actual premium paid? Is it a single premium or is it gross premium? Now you now see that the actual premium you paid is what? Gross premium. So the gross premium is equals net premium, which is net single premium plus what? The insurance expense.
Oh, this is confusing now.
All right, I know. All right, let's see what is net premium. Net single premium or net premium is equals mortality cost minus interest. That will give you net premium. Now, for you to get actually what you pay in your policy is called gross premium. The actual amount you are paying is what we call gross premium. And how you calculate gross premium is what? Net premium plus insurer expenses. So if somebody asks you, how do you calculate your premium? It's the gross premium, which is the net premium plus insurer expenses. Assume it's coming to the exam. They're not going to tell you to first go and calculate net premium before you come to calculate the gross premium. No. And of course, let's assume they want you to calculate the net single premium. They will give you the mortality cost. You have to minus it from any interest they give you. And what people don't know most times, for people who doesn't do mathematics, conversion of interest to other factors is as easy as every other thing. It's as easy. For instance, they give you 70%. What is the conversion there? It's 0.7. They give you 30%. What's conversion there? It's 0.3.
What?
So all those things, what if you let them, in case I don't think they're going to ask questions based on that. Most people have gone to this exam have not seen questions, math questions. But the math question you see there, do we not require you to get calculator? It's not something you use your mind to do. Of course, if there's calculator, the calculator is in the screen, but I don't think so.
Me no
When I
why
wrote
not? I like maths.
When I wrote my own, I did not do any maths. Anybody who does read and do maths, I don't think so. If there's maths questions, it will be something that you just know. You can just use your brain. Do that. No minus, plus, no. They just use those numbers to confuse you. Those numbers are used there to distract you. Those numbers may be distractors to the main question. So some people, when they see figures, they freak out, say, no, I can't do this, it's maths. Meanwhile, it's not maths. They see those figures to distract you. The answer is below you, you know. So the gross premium is the amount, is the total, that is what we are paying today, which is net premium plus insurance expenses. And the net premium, you now calculate the net premium, which is mortality cost minus interest. All right, so the gross annual premium is the gross annual premium is the gross premium adjusted for the fact that most people don't pay the policy's equal premium in a single payment. Instead, they typically pay for years. Of course, most people don't pay in a single payment. Single payment may need you good money to do that. So people pay in a number of years. The most important thing is to pay annually. That will help you. Instead of you not to pay annually, buy the little much you can be able to afford. If you pay monthly, the likelihood of that policy elapsing is there. So try and make your policy annual payments. Instead, reduce the first amount. Bring it down to what you can afford. Don't pay policy and you every month you not rest. No, you'll be thinking of how to do it. No. Always do as much as you can. It's better to get little than not to get anything at all. So do as much as you can. All right. So let's look at what we call premium mode. The term premium mode refers to the policy feature that allows the policyholder to select a timing of premiums payment. When do you want to pay? That is the premium mode. Do you want to pay monthly? Or do you want to pay annually? Or do you want to pay biannually? Or you want to pay quarterly? So those are the premium mode. Remember, the more you pay, the faster the cash value generated. So I did convert my individual life insurance. Today they sent the certificate to me. I think those who are following on this conversion, we use it as a point of lesson to learn for those who will soon retire from their job. You can convert your group life insurance to individual whole life insurance with cash value. So when you are retiring from your job, you can convert that your group life insurance, you can convert it to individual whole life insurance with cash value. So I just received the certificate today. I retired, I converted mine. So I just converted, they just gave me the certificate today.
Congratulations.
I was looking at because now if we're going to learn on it, I was looking at what the cash values, the growth of the cash values. So however, I paid annually. I found out that within that annually, the cash value generated that we generated for the year end will be close to, I think, 2,000 or something. That's what because the first place my eye go was the cash value. Yes. So I see is 2,000 something. So if I do 7 pay, if I do 7 pay, the amount that will be there will be more than 2,000. But I just pay annually. And what I see there is 2,000 something. So the term premium mode refers to how do you want to pay? Do you want to pay monthly? Or do you want to pay annually? Or do you want to pay semi-annually or quarterly? So that is premium mode. In case if you see it in the exam, premium mode is a how do you want to pay? So funding insurance premium. The most important thing is the funding. Everybody have to consider funding and the policy they write. Consider seriously funding, consider it. And while you are considering, look at other portfolio, look at other portfolio. Some of us have worked one or two places. You can roll over the 401k you have over there. So mistake people make is this. Please, if anybody has made that, don't allow anybody in your friends or your well-wisher to make that mistake. Now, when you're working with company A has 401k. You move to company B. Company B has 401k. You now bring the 401k you have in company A to put in company A. company, you have in company A to put in company B. You roll over what you have, going from fire to fire. So the money bring together. Yes, it's good to bring the account together, but I don't think there's need for that. If you have the knowledge, there's no need of bringing what you have in company A to company B. Say in the face of, oh, I'm trying to bring all the account together. Nothing wrong about that. But let me tell you, you're still on a volatile market. It will clear your eye when you retire. That is when you clear your eye that this money you have been fighting for bring together, there's nothing remaining. So the best thing you can do to yourself, that money you have in company A, don't bring it to the company B. Take that money out, put it in the annuity while you are working. While you are working. Some of you people don't stay in a job for more than 10 years. They lock in their retirement benefit there. They get it, they go out, they can go and work in another place. By the time they work off the 30 or 40 years of their job career, they must have worked in 4 or 5 places. And they must have differently acquired so many benefits. And see them when they retire, for those who knows how to invest, when they retire, they will start living good life. So fixed level, we have single premium funding. That is a policy you buy and you pay a lump sum amount to cover the entire policy. It's the most expensive type of payment that you can do. You buy a policy, even if $1 million policy, you ask them how much, they calculate the premium, total premium for you for the whole life of the policy. You pay it at once. That is single premium funding. Then we have fixed or level premium funding. Whenever you see level or fixed, what it means that policy, the premium remains the same. It does not change. So fixed or level premium is premium are spread evenly over this policy period. Of course, continue to pay the same amount. It does not change. The policy owner pay more than the actual cost in the early year to offset higher cost later, keeping premium level throughout the policy's life. Of course, we keep on saying that when you pay monthly, you pay more than what you're supposed to pay. It's clear. There's no two about that. Use your life auto insurance as an example. If you pay annually, if you pay monthly in your insurance, you pay higher. But if you decide to pay 6 months, you pay less. If you decide to pay 1 year, you pay lesser than 6 months. That is how exactly it's applicable to life insurance. So if you pay monthly, your premium will be higher. You pay annually, it will be less than what one person who is paying monthly. So that's how it is. The modified premium funding. It starts with a lower initial premium for a set period, after which the premium increases to a higher amount and remains constant. Who remember where we made this? Modified premium funding.
It's type of whole life insurance.
Good. You see, now it can be clearer to you. The
Yeah.
modified premium
Yes.
and the graded premium.
Mm-hmm.
And even the modified and graded in particular, they're the ones that confuse everybody, even in the exam hall. So you can see that. Let's look at the modified. It starts with a lower initial premium for a set period, after which the premium increases to a higher amount and remains constant. But in the definition we gave in the morning, we said it starts with low initially, then from what? From about 3 to 10 years or 6 to 10 years, it will increase to a steady rate where it remains until the life of the policy. That's what we said in the morning. And it's exactly the same thing with this, they said here. Modified premium starts with lower initial premium for a set period, after which the premium increases to a higher amount and remains constant. So that's modified premium funding. Now look at the graded premium funding. Graded. It begins what? With lower premium. Please, everybody pay attention. This should be one of the questions.
Degraded.
So let's look at graded. Graded premium funding begins with what? Lower premium
And
that
annually
increases
goes up.
annually.
Mhm.
Please always remember that. That's the difference we gave it in the morning, and that's exactly what it is here. It begins with a lower premium that increases annually for a specified period. After this period, the premium increases to a higher amount and remains stable for the remainder of the policy. You see, you have to put annually to what differentiate between modified premium funding and graded premium funding.
Mhm.
Yeah, please, annually must be there. That's the only difference between them. Now, flexible premium funding allows the policy owner to adjust premium payments throughout the policy life, offering flexibility based on financial circumstances. Everybody have been using flexible premium funding, flexible. And that is one of the characteristics of whole life or permanent life insurance. The premium is always flexible, which means you pay as you go. You pay as you go. You pay as you earn. You pay as your purse can afford. So that is flexible premium funding. All right. So let's look at paying premium from policy values. Paying premium from policy values. Depending on the type of policy, a policy owner may be able to use the policy cash value and dividend to pay the premium. Of course, we have seen it. You can use the cash value where you have automatic premium provision to pay what? To pay for your premium.
Premium.
You cannot be able to pay your premium after the grace period. Automatically, the automatic premium provision will set in where your premium will be paid from your cash value generated. So your game plan will be always make sure that you have raised a cash value. If you take your policy, if you log in to check your policy, I want you to, the first place your eye will go is the cash value. I told you today, I received and where my eyes go first is the cash value. I want to see the sequences of growth on the cash value. Definitely, they will table it out for you. When you invest so amount, not look at what the cash value will be. If you invest so amount, it's no longer based on the year. It's based on the amount you invested. That will determine the cash value. So that is what paying premium from cash policy cash value. You can pay premium from your cash value on using the automatic premium provision. You can equally pay premium for your dividends. The dividend paid by you by mutual companies from their interest or from their profit. The profit they make, they use it to pay premium for you. If you decide to accumulate the premium, you can decide to get the money premium as cash. You can decide to use it to pay your premium. You can still decide to use it to buy more policy. Definitely going to be term life policy. So that is how we can use your premium. Your dividends, sorry. So another one is using the cash value is cash. We have talked about one. So let's go to minimum deposit finance insurance. Let me tell you, most of the people, and you're going to experience it when you start the business. You will design a policy for somebody. You give them the money, the amount of premium they will pay. Let's assume you come to somebody, you design $500 policy to that person. Then that person is paying $500 as the premium payments. Now somebody come, say, oh, Mr. John, oh, you have a policy? He say, yes. How much policy? Say 500. How much are you paying a premium? Say 500. He say, how much premium? How much policy? Say 500,000. Then how much are you paying a premium? Say, oh, I'm paying $500. The person will enter his computer and design his own 500,000 first amount or first value, and design his own. The person is paying $250 monthly. So when you see such cases, don't shiver. explain the person the reason why you should take your own, not that person's own. Because that person gave him a minimum deposit that can finance that policy. In that case, will that person be able to receive cash value fast? No. That person may stay in the next 10 years and not generated any cash value.
Oh my God.
This is what people don't know. So somebody will come to you and say, oh, see, he wrote policy for me, $500 policy, 500,000 policy, and he made me, I'm paying $500 month as my premium. But this same person, another person come and design the same 500,000 to me, I'm paying $250. You don't know that they have clipped you. That policy is almost being useless in your hand.
Hey.
Yeah. So that's what people don't know. So when you pay such, you are paying just the minimum deposit to finance that policy. That policy. You are not paying to generate cash value. You are just paying to keep that policy alive. But this other person who has come to design that policy and you are paying $500, he is proposing a growth for you. He is making a financial place for you tomorrow. A retirement issue where you can save some money by generating cash values for you. So if you have such 500,000, another person who's paying 500 have the same 500,000. In 5 years to come, the person who's paying 500,000 will go to his policy and get money. But in 5 years to come, you would have spent $250 for that 500,000 policy. You go there, you don't see nothing. There's no cash value. But you have been convinced, made to know that the other person play wayo or play 419 on you. I don't know whether everybody know the language. Yeah, so these are tricks you should know. Sometimes cheap thing is chaos. So you should ask question. If you are designing this policy for me for I'm paying this amount, when will my cash value start? When will I start to generate cash value? Ask that simple question. Let that person that writes 500,000 and pay $250. Let him show you. They don't hide, they don't hide this one. After they design, if you design policy, you want to write policy for somebody, you design it, you see everything. You see when the cash value will start generating. You see it, they don't lie about it. So if you go and pay the minimum deposit, you are making the policy redundant, not being able to work for you. But people use that as a marketing strategy, to make more sales in the detriment of people. Just like in the olden days, where if they come to your office, they will say term life insurance without telling you the real ones, the other ones, the alternative. If you go to hospital for some women who are delivered here, you go to hospital, when you deliver finish, before you go, they bring what we call GABA. I don't know, is anybody have experienced that? GABA. They bring insurance to you.
Yes, for children, for kids.
Yeah, GABA. For things that they call it GABA.
Yes.
So they bring it to you. They will not ask you to bring other alternative for that baby. They just run up, give you GABA, which is term life insurance.
Oh my God.
They tell you that if you buy, it's $10 every month. Some parents bought. We bought it to, make I tell you the truth, the certificate is still here.
That's what you know.
We bought it, yeah. We got GABA. But we terminated it immediately. God help us. So that is exactly what. So the person that sold that $250 for 500,000 policy is just keeping your policy at the minimum deposit, just to keep the policy alive, nothing more than that. So, for example, each year the policy owner may borrow the cash value increase for that year, subject to certain tax restriction, and use it to pay the premium. The policy owner only pays the difference between the premium due and the amount borrowed, plus interest on the policy loan. So, policy loan, cash value only affects those who are funding their policy well. So additionally, under IRS rules, at least 4 of the initial 7 annual premium must be paid from the funds other than policy fund to avoid classification as a modified endowment contract, MEC. Whatever you are doing in funding your policy, try to avoid MEC. That is anything you have to know.
Try to avoid what?
MEC, modified endowment fund, modified endowment contract.
Mm.
Who doesn't know what MEC is?
Overpayment.
Overpayment, actually, overpayment, overfunding of your policy. Then if somebody asks you what is MEC, it's not overfunding, but what if you have a MEC in your policy due to overfunding, what happened to your policy?
The business.
Hmm?
Business. The
Business.
IRS
So
get
they will
involved.
they will tax it.
Yeah, start taxing you.
Mhm.
Everything on that policy, if you go and borrow on that policy, they will tax you. You take a loan, they tax you. You borrow, they tax you. The death benefit self tax. They see it, IRS will now see it as an investment portfolio. They no longer see it as a life insurance policy. Remember, life insurance policy, there is no tax on it. There is no tax on death benefit. There is no tax on what? Loan or withdrawal, except if you
Right.
withdraw more than the cash value. If you withdraw more than what you have in the cash value, they are going to tax you on the difference. Let's assume what you have 80,000 on your cash value, but due to a health problem, what you needed is 100,000 to solve your problem. And there's no other place you think you go to get that 80,000 without subjecting you to higher interest or anything serious. You remember that you have a policy. You go there, you have 80,000, but what you did is 100,000. You call the insurance company that you need to make a withdrawal from your cash value. They ask you how much. They ask you, how much is in your cash value? You told them I have $80,000 in my cash value. They ask how much you need. Say you need 100,000. But they say but you have 80,000. Yes, but I need 100,000. Are they gonna give it to you? Yes, of course they will give it to you. As far as your policy, you are paying your premium, they will give it to you. But when they give it to you, they're gonna tax you on the excess,
20%.
the 20,000.
Mhm.
The 80,000 will be without tax. They will tax you on the 20,000, which is more than what you have in your cash value. So that's how it works. So you can
So,
see
do you mean, say I have 50,000 in my cash value,
Mhm.
and then I want to take a loan of 30,000.
Mhm.
Okay, if I take that loan, wouldn't I pay interest on that?
There's a difference between interest and tax. You understand?
Say that again.
There's difference between interest and tax. Of course, you take a loan, you pay interest on that.
Okay.
But how much interest you're going to pay will not compare to interest you're going to pay outside when you go to the bank to borrow the money.
Okay.
You're going to pay at least, I think, 1% or 2%, something like that, interest. And the good thing about it is this. That money is your money. It's not true.
It is.
Nobody will come to you to say, Doc, pay your money. Nobody will call you on phone and say, come and pay your money. Nobody will send you to collection agency. It's your money. If you like, you can pay the interest if you don't like. But to put a good business for your interest to continue to generate without being touched, the best thing you can do to that policy is to continue to pay your interest as normal.
Mhm.
You understand?
Yes.
Just to continue to generate more, to continue to make way for future for you to get money there. But as you may did not pay, they're not gonna call you to come and pay. As far as you are paying your premium, they're not gonna disturb you. Nobody call you to come and pay the loan. The day the person passes, what happened? They bring out the death benefit. They will not remove what you are owing from the death benefit and give your beneficiary the remaining. However, you now begin to ask yourself, why do they say this money is my money? Of course, it's your money. Cancel your policy. That money, you're going to get it without anything. You understand? If you cancel your policy today, you're going to get that cash value. What they're going to do, they just remove all the charges from administrative charges. They're going to give you the money. So, but you take a loan, because it's loan, you're going to pay 2% or 1.5%, 2% of them of interest. So that's how it is run. Any other question? Please ask questions. That is the only way we can learn. Oh. That is the only way we can learn and make things clear to everybody. So let's look at, we are talking about premium. Let's look at end versus unearned premium. Ends versus unearned premium. Can anybody say anything about this? Ends versus unearned premium. Like if you see it in the exam hall. End versus unearned premium. Nobody here who doesn't have bills he's paying. Let's use your light bills. At least everybody now, some people is at work, some people is at home. If you're not at home, it may be some people, you have children, husband, anybody at your house now or at your apartment now. And the electric bill is there's light in your house. So my question is this: have you paid for this month bill? Electric bill?
Oh, yeah.
You have paid for this month bill, I think.
We do.
Right.
So which means the electric bill, you are consuming now, if you're in your house, the one you are consuming now, you have paid for it, I hope.
Yes.
Good. Which means you pay every month.
Mm-hmm.
So today is what? Today is
22nd.
22nd of January.
Yes.
And you have paid throughout the month. This month will be 31st.
Mm-hmm.
January is 31st.
Yes.
So remove 22nd from 31st. How many days remaining? It's about
9 days.
9 days or what? Or 10 days?
Mhm.
Maybe 9 days or what? 10 days.
9 days.
All right. 9 days, yeah. 9 days. Now, if 9 days remaining and you have paid the whole month, the end premium is from 1st of January till today. That is the end premium. Then the unearned premium is from tomorrow to 31st of January. I just use your bill in the house to give you an example what it is. So when you hear of end premium and unearned premium, so I will use the word the unearned premium is the one they have not eaten. The services they have not provided for you, but you have paid for it. That is unearned premium. Then the earned premium is the service they have provided for you, which you have already paid. They have earned it. The insurance company have earned it. It's also the same thing in premium payment in life insurance. For some of us who have life insurance today, you have paid your premium for the whole year. You paid annually, which means this is January. You have already paid for November, December. So from today, 22nd of January or 23rd of January to November is an unearned premium. Is an unearned premium. But from January 1st to today, 22nd, is earned premium to the insurance company. Please remember it. You may see it in the exam. So, and that is why when anything happens, the insurance company will return unearned premium to you. If you have auto insurance, car insurance, and you cancel them, you establish another company and you cancel them, what will happen? They will return unearned premium to you. The one they will take is the one that will end. Let me tell you, when we don't, knowledge is good though. When we don't know this, I change our insurance, auto insurance. I change to a new one. And we have paid for almost, I think we paid every 6 months. I saw a cheaper one, 2 months to the time, to the termination of that one, I changed to a new one. I did not remember that I have to call these people to terminate it.
Oh,
Until after about 2 to 3 weeks. Oh my God, I was so mad with myself. Oh, I said, I didn't call these people. Oh. I finally called them. Did I know that they're going to send money to me? I don't know. So after 2 weeks after that, then when I called them, we now calculated, so they said, all right, they're going to send so amount to me. I said, what? They said, they're going to send so amount to me. I knocked my head. Why didn't I call them on time?
yeah, it could have been more.
It could have been more. So that more they are returning to me or they return to me is the unearned premium. The service they have provided to me is earned premium. Yeah, I think it's clear to everybody now.
Yes, thank you.
So let's go to reserves. Remember this premium we are talking about, we say is divided into certain ways. Some can go to commission, some go to claim, some go to insurance company reserve, and some goes to cash value. So the part that's going to insurance company reserve, could they keep for any expenses or anything that come out of the company, they can use it to do. So we're going to look at those reserves. So as required by law, reserve also refers as unpaid claims reserve. We have our earned premium. These people have already made a reserve for claims that have not been paid. Claims that have not been even, nobody have raised, nobody have filed a claim, but I've made a reserve for where claims can be paid for. So you pay a premium, some of the premium is going to reserve, where the every insurance company have a reserve. And those reserve is what, remember those 4 companies that monitors companies surveillance and insolvency. Remember, the 4 companies. Who remembers those 4 companies?
Modi.
Modi 1. It's 4.
AM Best.
AM Best 2. Remember 2.
Some flesh, something.
Fetch.
Fetch.
What's the last one? What's the last one?
Moody's and Paul.
Yes. So you remember we talk about those 4 companies. I said, we discussed that what they do is to monitor the reserve of these insurance companies. So this is where their work comes to be. This reserve comes from the premium. Every insurance company makes a reserve for 20, 30, 40, 50, 60, 80, even 100 claims that they have not seen that will happen. So every insurance company have reserves where they keep in case if anything happens. So those Fetch, Moody, and all the rest, they go around to find out that to make sure that every company have adequate reserve in case of any emergency. That is why when something like hurricane happened in Illinois, where that hurricane happened, where a lot of people put claim at the same time.
North Carolina area.
Where a lot of people put claim at the same time. All the buildings, all the houses there put claim at the same time. Insurance company was able to pay it because they have a reserve for it. And where does this reserve come from? It comes from their premium. So that's reserve. When you pay a premium, some of the premium goes to the reserve. So each state has own requirement regarding the amount of funds that make up the reserve. So reserve also demonstrates an insurer's surveillance. The reserve are funded through the future premium payment from policy owners and the interest investment return earned on those premiums. You pay a premium, they put it at the reserve. Those ones they put the reserve, they reinvest it. So as the market is good, those reinvestment is bringing more money to them. They are putting into a reserve because the money they use to invest come from the reserve. So you can see how this money is circulating. The reserve come from your premium. You pay your premium, some part of it go to reserve. They now take their reserve to invest. The money, what the profit coming from the reserve is coming to the reserve account. Now it will be the profit coming from the reserve plus the reserve itself. So you can see that the reserve, the more you have a reserve, the more money you have in your company and the more solid surveillance the company becomes. So that's why it's difficult to see insurance company falling. That's why you see them. Have you seen that insurance company collapse, maybe folded, just like you see in banks? No, you can't see that because banks take their money to go and put insurance company. It generates interest for them. Virtually, if you look at banks not really doing anything for you. I'm telling you, I'm not condemning it. They just put it there. It's just bank money is supposed to be in the bank. The money you are using now. Banks can generate good interest for you because those who are taking your money to invest for you are using the money to go and invest.
So, sir, quick question
Go ahead.
or clarification. So, insurance company solely makes their money by investing our premium into the market, mutual funds and stocks.
Of course.
Meaning, so why are the banks not doing the same thing? If they
No, the banks, remember, the capability of insurance company to invest. All right, let me say this so that you can know it. Banks and insurance company are not the same. Insurance companies are more protected by law than banks. You know the maximum amount if banks fall today or collapse, you know the maximum amount you can collect from a bank, no matter how much you have.
250,000.
All right. So by law, even if you have 1 million there, they're gonna pay you 250,000. But insurance companies are being funded by federal, by the state. Insurance company cannot collapse. So that's why the banks will turn around to go invest their money in insurance company. And that's why all the banks have policies today. So you can see that insurance company is stronger.
Okay,
So,
does that mean that the insurance company are they owned by the government if they are getting all this protection?
Is the law.
remember, some of them is owned by government, some of them owned by individual, but the law gives them that perfect protection. The law provided that perfect protection for them. The law provided that perfect protection. Most of those people who are on top government, most of them have policy, have insurance. In fact, most of them, their investments solely on life insurance. So the protection is the law that gives them the protection. Yeah. I have not heard that big. At least we have had since.
What's going on now? Are we okay?
So that is it. So we compare life insurance policy cost. Let's compare life insurance policy cost. The cost of a policy is the difference between that a person pays, what a person pays, and what they received in return. If a person pays a life insurance premium and receives nothing back, the cost of the death protection is the premium. If a person pays a premium and receives something in return, e.g. a dividend or cash value, the actual cost is less than the premium paid. Of course, did you hear it? And that's exactly what it is. For instance, in term life insurance, you pay and you get nothing in return. You paid premium, you get nothing in return. So in that case, the cost of death of protection is that premium you paid. If you pay, you do not receive something in return, just like in term life insurance. Then the cost of that death protection or the cost of that protection is the premium you are paying.
Mhm.
So the premium you are paying is indirectly what they are using to pay you the death benefits. That's exactly what it is. But if you are paying a premium and you are getting something in return, you're getting something like dividends, you're getting like something like cash value in return. Does that have the same definition with the one you are paying and nothing getting back?
No.
So that should be the basis of your making a choice of the policy you want to buy. Therefore, a lower premium doesn't automatically mean a lower cost policy. Cost comparativity method evaluate the actual cost of the policy against this standard. So you want to pay and have something in return. If you pay, you don't have something in return, means that they are using your premium to pay you to pay for the protection they give you. So you can see that's exactly what term life insurance is. Of course, they use the premium you're paying to pay for your protection. If you have any problem like death benefit, they use from the premium you pay to give you back.
No cash value.
Yeah, no cash value, no dividends.
No dividend.
That's it. So let's look at interest-adjusted net cost method. These interest-adjusted net cost methods are designed to provide information on the following 4 items: premium, death benefits, cash value, and dividends. In fact, at any policy you are writing and these 4 items are not there, just leave it. At least 3 of them should be there. Then you know that it's not policy. Of course, you must have premium. Of course, you must have death benefits. Of course, you must have cash value. And of course, if you choose, you must have dividends. So dividends is an added advantage to a policy when you write policy in mutual company. Because if there is a gain, you are participating on the gain. If there's a loss, you are participating on the loss. But most often, the gain is supersede the loss because you can never see people who lost. I've never seen insurance company who lost. However, if there is a loss, you're still going to participate to survive the loss. They're going to increase your premium a little bit to make sure you survive the loss. So these are the 4 factors. There's the interest-adjusted net costs method. The interest-adjusted cost method was designed to provide information on the following 4 items. It must have information on 4 items, of which we have almost gone through all of them. So this variable must be considered when evaluating costs, and they form the basis for life insurance policy cost comparison method. The what? Premium, the death benefit, cash value, and dividends. They are used for policy cost comparison method. Now, the index number are designed to provide consumer with means of comparing the cost of policies of the same generic type. The indexes also take into account the insured age and the desired coverage amount. Each insurer and its producer must use the same comparison formula to determine the index numbers. So, due to increasing complexity of life insurance policy structure, premium payment method, benefit and dividend configuration, the average consumer would struggle to make cost comparison without these index figures. I don't want us to waste our time here. So the National Association of Insurance Corporation Model Life Insurance Association regulation requires two interest-adjusted cost indices for policy illustration: a surrender cost index and net payment cost index. You may not, I don't think you may see it in the exam, but in case you see, just know that the NAIC uses two cost indexes for policy illustrations. The policy illustration, you may not understand what it is. The policy illustration, if you have had policy before, you see that the agent that writes the policy for you was talking about illustration. Illustration is just like policy design. In that illustration, we want to indicate what do you want, the purpose of the policy. Why do you want to establish a policy? What do you need? Do you need more of protection, or do you need more of accumulation? Do you need to make wealth, or do you need to, first of all, protect yourself? So these are what you're going to put into consideration when you are doing illustration. So what are the indices you use in making illustration? They are what? The cost index and a net payment cost index. So these are the two. These are just the two things you know. So interest-adjusted cost indexes: premium, death benefit, dividends, and cash values. You may or may not see it in the exam. Insurance surrender cost index. Of course, you can always, when you surrender policy, when you're talking about receiving anything, receiving a surrender value is only when you have a cash value attached to your policy. If you don't have a cash value, there's no surrender value. Even there's no surrender cash index, you cannot be talking about it when there's no cash value. Because the growth of your cash value will determine all those cost indices. I think this one's, I don't think it may be necessary. Comparative trace rate method, I don't think it's necessary. But net payment cost indexes are, well, net payment cost index uses a similar formula, but uses not, let's not waste our time here. Application example. Vertical settlement. Yeah, you need to know this. Vertical settlement and life settlement. A vertical settlement enables an individual with a chronic or terminal illness to sell their existing life insurance policy to a third party for a percentage of the policy face value. I think, do you guys know that you can sell your policies to another person, to third party? There's some people, their job is to buy policy from people. Yeah. If they buy the policy from you, they'll be paying the premium, waiting until when the person will die, so they can collect the death benefit. So vertical payment settlement is when you decide to sell your policy to third party. You pay you the money, at least you use the money to treat yourself or to settle yourself. So vertical settlement enables an individual with a chronic or terminal illness to sell their existing life insurance policy to a third party for a percentage of the policy face value. So you sell the policy to the third party, he give you percentage of the death benefits. So if you have a face value, is there any need to sell a policy? If you have a policy that have a cash value, do you think there's need to sell your policy again? Is there any need? If you have a policy today that has cash value, and you have funded that policy well, and have a good cash value, do you need to sell your policy to take care of yourself?
No, you're gonna lose all the cash values.
Is that?
I say if they sell it, they're gonna lose all their, all the stuff that they've saved up, all the cash value.
Yeah, you're right. But in essence, what I'm saying is that if you have a cash value, you don't need to sell your policy to get percentage of the death benefit or face value to be able to treat yourself. No. That's vertical settlement. You are sick, terminally or chronic or anything or critical anyhow. You don't have money to take care of yourself. You just go say you're gonna sell this your policy. And the reason is that you want to get some money. to treat yourself. Because when you sell it, the buyer, which is the third party, will give you percentage of the death benefit he will receive when the person passes. So that is how we call vertical settlement. But if you have a cash value, let's assume you have a policy 500,000, and you have already funded this policy that you have close to 300 and something cash value in your policy. Do you need to sell that policy to treat?
You can take from the cash value you have.
All right, that's what I was trying to let everybody understand.
Mhm.
There's no need for you to involve yourself in vertical settlement. You take your money from the cash value to go and take care of yourself. That's what I'm trying to everyone to understand, to say. So you don't need to go and do a vertical settlement. You don't have to take care of yourself. When you have generated a good cash value that you can take, even if you like, take excess, take above the cash value, it still can be granted to you by the insurance company. Instead of you selling their policy totally, using a vertical settlement so that you sell it to third party, so the third party will give you a percentage of the death benefit. Anyway, some people, people reason differently. Some people will see it as the best option to sell. So that's vertical settlement. Who is the vehicle? The vehicle is that policy owner, referred to as the vehicle. And who is the vitee? Vitee is the vertical person, the third party. You understood? The vehicle is what? You who sell your policy. Then the vitee is that person who bought the policy, the third party, the vertical vitee. So that's vertical settlement. You may see it in the exam, at least know what it means. What I need you to know is just know what it means. If you see it in the exam, you remember. They're asking the question. If you know what it means by your own word, if they ask it in the exam, you know what you honestly will remember it. All right. I think we are not fast. Life settlements. Life settlement, in many states, vertical settlements are being replaced by a life settlement. Of course, many states see that as a fraud. Vertical settlement seems to be a fraud. Because if you say a policy to somebody, the person will pay you part of their death benefit. That person may likely be party to people who will kill you and make sure they receive the money. No, it's the truth. When they don't have cash, they'll be looking every day. They open their window to see whether the person has passed. Yes, because their money will come back to them when they passes. That's when death benefit will be paid. That's the truth. So most states don't want it. Most states don't want it. Most states replace the vertical settlement by what? Life settlement. A life settlement is the sale of an existing life insurance policy to a third party for more than its cash surrender value, but less than its net death benefits. So most states remove this vertical settlement to replace it with life settlement. Is also selling to, you say a life insurance policy to existing life insurance policy, you sell it to a third party for more than its cash surrender value. Remember, in your policy, you have a cash surrender value. What is that cash value, surrender value? What is the cash surrender value? Who can tell us? Who can tell us what cash surrender value is?
Is that the amount of money that you get? The
After you cancel.
The insurance company give you when you decide not to. When you decide to part away with the policy.
Yes, that's it. That is exactly what it is. You're right. So what we are saying is that in life settlement, you part away with that surrender value. They give you the surrender value and you collect the policy. Poverty is not good.
Not so.
So it's just because
And
someone don't have,
ignorant is the worst.
yeah, if because someone don't have money, that person will be taking this line. So let me sell it.
That's ignorance.
Oh my God. So this one, you sell it to a and what you're going to sell will be exactly the surrender cash surrender value.
Hmm.
Yeah. So that is what this one mean. Life settlement is no longer vertical settlement, now life settlement. It's to the cash value, you know. It's not cash, but less than is death benefit, of course. It will be less than the death benefit, but closely approximated to the cash surrender value. So unlike vertical settlement, life settlement don't require the insured to be suffering from a chronic or terminal illness to sell and transfer the policy. So the only factor, only key you must understand in vertical settlement is this. The condition is this. That person must be suffering from chronic or terminal illness.
Illness.
That's the only condition that can result to
Vertical.
vertical settlement. And let me tell you, if you have a terminal or chronic rider, do you need to involve yourself in vertical settlement?
No.
Huh?
No.
No. You don't need it. You don't need to sell your policy. Because if you have a critical or chronic rider or terminal illness rider, you apply, the company will give you 90% of the death benefit, and your policy is still alive. So why must you pay? Why must you go and sell it again? Anyway, it's ignorance. Somebody said it's ignorance.
It's ignorance.
It's ignorant. So if not, tell me the reason why you should say when you have a chronic and or terminal illness rider, why must you mess with the policy again? No, you don't need this. So anyway, the only comparison you should know that the vertical settlement, the condition that that person must be suffering from terminal illness. So that's the only condition. So life settlement contract don't include the following alternative. An assignment of policy is directed by a lot. Those things, there's no need to be wasting our time there. So let's look at life settlement chart. Life settlement contract don't include the following alternatives. One, look at this chart. I'm going to make it bigger somehow. You're utilizing policy as collateral for securing loan. Is everybody seeing it? I make it bigger. Is everybody seeing it?
Yes.
All right. So these are what? Life settlement contract don't include the following. It does not include the following. Utilizing policy as collateral for securing loan, provision of a policy loan or the payment of surrender benefits or other advantages the policy issued or associated with. A 1035 exchange of a life insurance policy as defined by the Internal Revenue Code. What is the 1035? Anybody remember?
You use it in conversion.
Use the conversion, good. That's what I want to hear. So an agreement among parties who are closely connected to insured by familiar ties. So these are it's not involved with this unless we always have time. Know what life settlement and vertical settlement is. All right. So life insurance, you must oversee coffee. Life insurance death benefit. When the person dies, that's when the death benefit will come. So let's look at settlement option. I think we are still going to see settlement option. Life insurance policy contains a provision. The settlement will be paid upon receipt of proof of death certificate. Most states require insurer to pay interest or any unpaid proceed from the specified period. Death benefits can be paid out in various methods referred to as settlement option. So when you're writing your policy, you're going to include the settlement option, which means the method in which the proceed or the death benefit will be paid to the beneficiary. Is everybody get it?
Yes.
All right. So it's something you're going to put on your policy, how the money be paid to the beneficiary. So the policy owner may select a settlement option at the time of application and can change it at any time during the insured lifetime. You see why you don't need to bother sometimes. You use anybody to write your policy, put as a beneficiary, and how the money be paid. You can change it at your own time, at your own way. Do not bother. I have this family that the wife was complaining of that he doesn't want so person in her policy. So I asked her, what happened? Why don't want the person? He said he doesn't want at all. I said, all right, log into your policy, go and do it by yourself. You don't even need to call insurance company. You don't even need to tell me. Go to yourself. I teach you how to log into our policy. She log into our policy. I said, go and solve your problem by yourself. I don't want to know. It's because you can change it at any time when you want. The settlement option can be changed by you. As far as the owner of the policy is still breathing. You don't need a third party to know what you're doing. You can do it by yourself. So the policy owner may select a settlement option at time of application and can change it at any time during the insured lifetime. If the policy owner selects a settlement option, the beneficiary cannot change it. However, in most cases, the beneficiary makes the settlement selection at the time of the insured's death. So it's just like you have written what will be. What will be is what will be. Nobody will change it, even if you are no longer alive. How the money will be distributed. It's become a problem when you do not share this thing, when you do not say this is how it will be paid. If you decide that they should not collect it as a lump sum, they should be collecting it every month to take care of their monthly bill. Then what it means that for the next 2, 3, 4, 5 years, depending on the policy you bought, for the next 10, 20 years, you are paid their income for the month, every month. You can decide that every month they should go there and collect money. You can decide that this money, you don't want to be people to use it anyhow. This money will be used to pay for my grandchildren's school fees, tuition. Anybody from one generation to another. You keep the money there. The money will be generating interest when it's not being used. When it's being used, the interest and the principal are there with you. So the number of years you left that money there is generating interest for you. So that is it. Now, unless the policy owner specifies an irrevocable settlement option, the beneficiary always retains the right to withdraw proceeds at any time in the future. Any option selected in which the policy proceeds are left at interest with the insurer protect the beneficiary against creditors' claim. So the most important is that the creditor does not have access to your account, period. Nobody you are owing will come to you and say you want to collect the money because the person have died. And the person is owing me social amount. I know that he had cash value, he has life insurance. Let me come and collect the money. No. You are protected by law. All right. I think we may definitely stop here. It's something. So we're going to start tomorrow morning, death benefit settlement option. So we're going to begin now to discuss the settlement option, the way that proceed can be paid out to your beneficiary. That's what we're going to start discussing, the death benefit settlement options and lump sum, cash payment, interest only. So we're going to discuss them tomorrow. All right. See everybody. Good night, everybody. We're going to start from here. We have tried for today.
Thank you.
We have started for today.
Thank
Please
you so much.
continue to read. For those who write the exam, I wish you success. Go there, do as you can. Remember, it's school you send to yourself. Nobody send you. So do not worry yourself. You go, if you didn't make it, and I pray everybody make it. You come back and don't waste time in registering. Just register so that you don't forget those the ones you know already. Because if you do not register immediately, what it means, you're going to forget the ones you know. Remember, you're not in school, back to school again. You have a lot of things, bills and the family, everything around you. So I know everybody is struggling, but this is the promise we make to ourselves and to our generation, means that we're going to do what we're going to do to make sure that we have that financial knowledge. Even if you not do the business, get the financial knowledge. So there's need for you to sit here today and listen to this so that the tomorrow will be better. All right. Good night.
Thank you. Good night.
See you guys tomorrow.